at RNM. I request you all for active participation throughout the webinar. If you have any questions, you can share them in Q&A box. And now I would like to hand over to Mr. UN Marwa, who is Senior Partner at RNM, for welcome note.
It's a pleasure to welcome all of you, particularly two members here who are like family. Amit Khosla is who has grown up in front of me and is today doing exceedingly well as investment banking in a private equity. He's got 26 years of experience in the private equity and investment banking field. He's the founder of World Trust Capital and has earlier been a senior management positions in organizations like Catalyst and Asia Capital. Welcome, Amit. Look forward to hearing what you have to say about the markets today and future. And of course, I have Shikha here, who's the daughter of a very, very dear friend of mine, a chartered accountant colleague. Shikha is a certified Bitcoin professional and co-founder of Main Chain Research and Consulting, and is a prominent figure in blockchain and cryptocurrency network. She's in the advisory panel of IMA's subcommittee on cryptocurrency and blockchain. She's actively involved in the international crypto ecosystem as a writer and speaker, engaging with business users and officials on the concept, technology, and regulatory evolution. Welcome, Shikha. Welcome to Alex, who has 18 years of experience in strategy, financial markets, capital raising, and operational execution across sub-Saharan Africa, Mauritius, and India. Between 2013 and 18, Alex was the managing director of CIEM Healthcare Africa, growing the healthcare cluster of CIEL Group. Between 2002 and 13, Alex ran across functions within Fortis Healthcare in India, Mauritius, and Uganda, in corporate finance, accounting, and business development. He's also worked with EMAR MGF Land within the capital raising and investor relations activities, and is on the board of large corporates in Mauritius and Mauritius. Welcome, Varun. Varun has 15 years of experience in the areas of merger and acquisition, fund mobilization, valuation, and asset management. He's worked on multiple complex transactions across sectors like real estate, IT, logistics, hospitality, and healthcare. Prakash Jain comes with 15 years of experience in the field of corporate and international tax, service tax, and GST laws. He advises domestic and multinational companies on various tax matters, including assessment, structuring, etc., and GST. He is presently in Bangalore, right? And last but not the least, I'd like to introduce our host, Raghu Marwa. Raghu is the CEO of RNM India and is leading the firm. His expertise is on advising and structuring businesses overseas and on behalf of Indian corporate clients. Entry strategy for foreign clients to set up businesses in India, transfer pricing, and overseas taxation. I would now like to hand over to Raghu to moderate the ensuing session, and I'm sure we'll all find the panel discussion highly interesting and absorbing. Welcome to all, and thank you.
Thank you, Mr. Marwa. Welcome once more to everybody present. We have in the past done how-to sessions or webinars on different how to scale a startup, how to raise money, how to find the right startup idea, how to identify the right jurisdiction. And now before you today, the topic is how to pick your alternative investment in 2022. Our next webinar, just for all of those who would like to be present, is on the budget, how the union budget is going to impact you, which is going to be on the 25th of February. And we've got a host of industry experts and CEOs from agriculture, healthcare, and the EV space who are going to be talking about the budget and how it's going to be impacting you. But back now to the current topic at hand on how to pick an alternative investment. And I'd like to begin with quoting Warren Buffett, who had famously said that we don't have to be smarter than the rest. We have to be more disciplined than the rest. So let's hope that we all are very disciplined in our investment approach. And I'm sure we'll learn a lot from the panelists today. But what is alternative investments? Alternative investments covers a wide range of investment options from PE or VC investments, private debt, hedge funds, real estate, commodities, collectibles, and structured products. Investors in alternative investments are generally HNIs and institutions looking to address shortage in aid or alpha, income, and diversification in their traditional portfolios. The Indian market is poised to become the 5th largest equities market in the world after US, China, Japan, and Hong Kong. And more retail investors are joining in every day. Accredited investors must be an individual whose income exceeds $200,000 for the last 2 years as per the US SEC norms, whereas in India, an accredited investor is an individual with an annual income of 2 crores or net worth of 7.5 crores. As per data published by SEBI, as at 30th September of 2021, the total amount of commitments raised by alternative investment funds, AIFs, in India is US $72.3 billion. As per Preqin, which is another research agency, the AUM under alternative investments globally was approximately $10.2 trillion. So clearly this is a very big market of alternative investments that we're looking at. With startup investing becoming mainstream, with Shark Tank India getting an audience across drawing rooms of India, there is an increasing interest in venture investments in structured products. With a budget round the corner, there have been requests to amend the definition of startups to remove the turnover limit and the IMB certificate requirements. ESG, or environment, social, and governance considerations, is steering a lot of alternative investment dollars towards emerging markets investing, including in Africa. We have as we heard, Alex, who's a specialist on Mauritius. We're going to hear more from him later today. Investing in cryptocurrency seems to have caught the fancy of Indians in 2021, with an estimated 100 million crypto owners in India as per the platform Broker Chooser. Shikha is going to be talking a little bit more about that topic and the pitfalls as well as the opportunities that lie there. P2P lending, REITs, and new age fintechs have become so popular that RBI has recently set up a new department to regulate and supervise them. Varun is going to be telling us a little bit more about that. And we end the topic today with taxation, on REITs, tax on carried interest of AIF fund managers, tax on gains on crypto, NFT sales, tax on AIF category 3 investors, and the benefits of AIF being structured through Gift City from a tax point of view are some of the hot topics that we're going to discuss with Prakash today. I read an interesting book over the New Year break called The Psychology of Money by Morgan Housel, where the real life story of a janitor in the United States was narrated, who died with $6 million in the bank account. His story illustrates the point that you don't need a college degree or to be a finance whiz to make smart money decisions. It is a lot about your behavior, being wealthy as against being rich, investing early, letting the money compound over a long period of time, staying the course when the market drops, and in the end, being reasonably sensible rather than coldly rational. It was a great way to think about money and start 2022. And with that, we're going to straight away dive into the first topic with Amit, which is on investments in fast-growing structures. I'd like to ask you, Amit, about your investment approach and the value that behavior comes to bear on your investing approach. What you would like to advocate for people in terms of whether you're the example that I gave from the book, or whether you do think that you have a different take on investing. So over to you, Amit, for your views on your investment approach and behavior.
Thanks, Raghu, and thank you, Mr. Marwa, for having me over here today. So just, when we look at the universe of investment opportunities, right, there is high level, there's equity, and there's debt. Then within you go, if you look at debt, you have structured debt, and then you have alternates, which we call, there are hedge funds, there are real estate funds, there's venture debt, there's what we call equity PMS strategies. There are so many strategies. So the issue is, how do you decide between these asset classes? Now, I've always said that you can always time entry into markets, but timing exit into markets is virtually impossible. There are not very many investors who manage to get that right. And therefore, the approach is time in the market is more important than trying to time the market. But given we're doing it, how do we address it? So I look at three things that you should look at very carefully when you're looking at deciding between different asset classes, how much to allocate. And the key thing is, what is the risk that you're comfortable with? And therefore, you only get a return which is a function of the risk. There's something we call risk-adjusted return. You don't make returns without taking risk. So you need to be careful as to what is my risk-adjusted return. The second thing that is very important is asset allocation, which is there was an old saying, you don't put all your eggs in one basket. So no matter how good an asset is performing, you must make sure that you must allocate between different asset classes. That's the second aspect. And the third aspect, of course, when we all think of this, and especially when we look at family offices and HNIs, is legacy and inheritance. Whatever portfolio I'm creating, how do I ensure that it goes down to the next generation in a proper manner? So, I'll go through all of these one by one to just quickly kind of walk you through it, right? One is, you always measure for, any investments you do, you need to research them, you need to monitor them. And you need to monitor them and again and again and again. You can't just monitor them once and forget about them. So, let's think about it, right? There's risk-adjusted return, which is, for example, if I'm doing a mutual fund, an equity mutual fund, and it's giving me a 10% return. And then a lot of people say, should I invest in a PMS scheme or an AIF scheme? And my answer to that is that when you compare the different instruments, if an equity mutual fund is giving me a 10% return, then a portfolio management scheme, which is a specialist who's doing equities, should give me 15%. If he's not giving me 12, 13, whatever you want to benchmark, because if you're not getting higher return for the concentrated risk you're taking, then I would rather do a mutual fund and at least make sure that I'm on a more diversified portfolio. Similarly, when we look at things like AIFs, right? And AIFs have a 7-year or a 9-year lock-in. Again, it goes to the same thing. If an equity mutual fund is giving me 10%, if a PMS is giving me 13%, if that's the premium I'm putting, and every individual puts their own premium, then an AIF should give me 15 to 17%, because not only do I have a concentrated portfolio, but I also don't have access to liquidity. Once I've put money in, it's illiquid. So the way to think about risk-adjusted returns is to look at concentration. Do you have a specialist? And then also, is there liquidity for my capital? And as you go higher up the chain, the return has to go up. But because, and when we look at a lot of the alternate strategies in India, and you look at the returns, and if I look at alternate strategies and say they've performed as well as PMSs in the country, then as far as I'm concerned, alternates in India are not successful. There are very few AIFs in India who have delivered an alpha over and above the PMS strategies which are there. The other thing to also think about, and Raghu, your point about behavioral analysis, right? It's easy to say it, but what does it mean? So one is stay in the market, but there's also a concept in fund management which we call vintage risk, which is when you invest, you don't invest everything in one vintage in one time. You kind of say, I'm going to, if I have 100 rupees, for example, I will say, okay, let me invest 30 now. Let me invest perhaps another 40 next year. And let me perhaps invest another 30 in the last year, over 3 years. Vintage risk is important because markets go through cycles. So, you can have a great company, but if, we've seen what's happened in markets, whether it's India, whether it's the US in the last 1 month, right? These, the same company is now available perhaps 20%, 30% cheaper than what it was in mid-December. So no matter how good a company is, I need to manage vintage risk in my investments. And I think that's the biggest behavioral aspect that we look at. When markets are going up, everybody is very bullish and they say, let's invest more, let's invest more, let's invest more. And then when there's a massive correction, people say, I don't want to invest. And my answer to them is, you bought the same company when it was 40% higher 6 months ago, and today you're not buying it. So are you playing a stock price, or are you playing the fundamental analysis of how good a company is? Now, a lot of people will not have the ability to differentiate between the two. So you just think of vintage risk and say, no matter how good a market is, I'm just not going to invest all of it at one time. So vintage risk for me is the most important part of discipline in investing. No matter what happens, identify your strategies. Don't put all your eggs in one basket. Diversify your portfolio, right? I mean, I've seen people saying, I'm never going to invest because I lost money in 5 stocks. Well, the mistake was you shouldn't have done 5 stocks to begin with. You're supposed to have a portfolio, equity portfolio. You say 40% large caps, 30% mid caps, 30% small caps. So that's your equity bucket. If you look at venture, for example, right? Venture, we know that if you do 100 companies, 2 will be successful, 98 will not do well. So if you're doing venture, make sure you have, for example, 1 crore of investments. You take 100 companies, or you take 50 companies and say, I'm going to do 2 lakhs in each company. We have to create a portfolio. What happens is people will take all their money, put it in one company, and then they'll say, this market is too risky for me. So asset allocation is very important. Vintage risk management is very important. And, it's easy to say this, but it's very easy to sit on cash and not do anything. Oh, the market is too risky, I don't want to do anything. You have to participate in the market. And therefore, the way to address it is just 2 things: asset allocation, vintage risk, and then you sit tight. And, before I close, just the last thing I want to say, Raghu, on this is, we look at 3 things, right? Most investors look at debt and equity. And they say, if I want to manage risk, I will do so much in debt, so much in equity, and I'll manage my returns. But there is another way of looking at it, which is what we call a conserve portfolio, a market portfolio, and a multiply portfolio. So a conserve portfolio is a portfolio where you're saying, I just want to get as much returns as inflation. So I want to manage the value of my money. So your investment strategies are in low risk, highly liquid assets. You need to decide what is the right thing for you. So somebody who is 80 years old should do a conserve portfolio. However, somebody who's 50 years old should do a market portfolio where it's a combination of debt and equity and a little bit more risk, and say, listen, I want to beat the market, right? And then somebody who's really young and subject to obviously having enough liquidity will look at a multiply portfolio, because they're going to say, I don't need money for the next 20, 30 years, and I want to multiply the value of my wealth. And therefore, you look at more alternates. So, vintage risk management, liquidity, and just think about whether you want a conserve strategy, a market strategy, or a multiply strategy. That's enough of a discipline. Most investors are not, we all follow Warren Buffett, but we don't really have to, we're not going to learn what he does through books. But if we just follow some basic steps, you'll manage. That's all that I want to say about.
Thank you so much, Amit, for that. I'm going to jump ahead on a question which I think takes a lot of headlines these days, is technology companies. And you, of course, with your background of being in the private VC space and now in the public market space, have seen both sides of the coin. What is your prognosis about technology companies from a valuation perspective? Are they overpriced? Is it because that they are the future and there are a very small, narrow bunch of them who've managed to reach the public market and they are grabbing all the attention? What is your prognosis for the future on technology companies? And this I'm asking not only from India, but I know you are very active in the US market and the US technology, FANG stocks and so on and so forth. So what is your take on this?
So the reason you want to invest in technology, and the reason I say we should invest in the US in technology, is because as an investor, I want an exposure to all equity asset classes, right? I want exposure to financials. I want exposure to energy. I want exposure to, real estate. I also want exposure to technology. And the reality is, unfortunately, in India, when you look at the listed space, there aren't very many true technology companies. Right? What we've got is service providers. They're not real tech companies. So therefore, by default, you have to kind of diversify. Raghu, you mentioned India is the 5th largest equity market in the world. Actually, if you look at the world in terms of market capitalization, right, and I mean all products, not just equity, the US is 43%, China is 11%, Japan is 3%, France is 6%. India is 3% of the global equity market cap. So the issue is, if I'm an investor and if I have the whole world to invest in, why should my equity portfolio only play in something which is 3% of the world's market cap? It makes no sense. I want to participate in global equities. The Reserve Bank of India allows me to do it through my LRS, right? So why should I not do that? So the reason you want to do technology is because it's not there in your Indian equities market. The reason you have to do it outside of India is because, unfortunately, there aren't very many technology listed companies in the country. Why should you invest in tech, right? It's very simple. I mean, if you look at, putting some numbers in perspective, right? If I look at Apple, Microsoft, Amazon, Google, Facebook, right? And this was, my numbers are again December numbers. The market cap of these 5 companies is $7.3 trillion, right? Raghu, this is 2 times the market cap of India. So if I just take the 5 big tech companies in the world, right? They have a market cap in excess of India, the Indian stock market. So what are we talking about, right? We're talking about a totally different world. And as an investor, why should I not participate in that world? Right? So, there is a lot of people talk about valuation of these companies, right? Are these companies overvalued? Are they too expensive? Think about it, right? Apple has a return on equity, and the numbers just came out, of 147%. Microsoft is at 50%, Google is at 30%, Facebook is at 32%, Amazon is at 26%. These are staggering numbers for companies, which, if you look at the amount of cash they have in their balance sheet, if I look at net cash, the debt equity ratio of these 5 companies is less than 1. So here's a company which is delivering me 30% EPS growth year on year, has got a return on equity which is in excess of 50%, and a debt equity ratio of less than 1. And the PE multiples, Facebook trades at 25 times PE multiple. At what valuation Indian companies trade in our stock market, right? So actually, a company which gives me these kind of numbers is not that expensively valued. These companies have a cumulative revenue of close to $80 billion. and they generate a free cash flow of 20% year on year. These companies generate $15 billion of free cash flow year on year. What do they do with that money? They'll either buy growth, they'll buy companies, or they'll do share buybacks, which is why their EPS just increases. So there is a, if we look outside of our 3% of the world, there is a massive world out there. And there's no reason why as investors, we should not be participating in them. So, that's my little take on it. We have to, and we're all consuming it, right? So, when I buy an iPhone, it's, or whatever technology I consume, I mean, all of us, we're using, people don't know about Amazon. Amazon's biggest revenue is not its retail. It's not Amazon shopping. It's Amazon cloud services, right? So we keep on, I study economics, and the interesting thing that people say about technologies is that the old, we had when we were in school, we studied demand, supply, and there was this scarcity of resources, right? And therefore, for X resources, you could only produce so much. The thing is, in technology companies, there is no, they've broken the economics barrier, because I can create as much cloud space as I want. So that limitation of resources, economics theory has suddenly just fallen apart, and they're changing the world. So before I finish, I just want to tell you, there's a new phrase which came out in this week's Economist, and FANG is out, right? It's no longer Facebook, Apple, Amazon, Netflix, Google, and it's now MAMA, MAAMA, which is Meta, Alphabet, Amazon, Microsoft, and Apple. So it's changing, the world is changing, but the world is recognizing that big tech is here to stay, and there's no reason why we shouldn't participate in technology. We consume it, yeah.
Absolutely. Thank you so much. I think we have great takeaways on vintage risks as well as on all the mama valuations. I think we all have learned a lot. With that, I'm going to switch gears, and I'm sure there are a lot of questions out there. Please hold your questions till the end. But we're going to switch gears to cryptocurrencies and investment in cryptocurrencies. We've got Shikha here, who is going to help us understand a little bit more about whether or how you should be investing in cryptocurrencies in 2022, given the background of all the crypto crimes and the meme coins that are out there. Over to you, Shikha. What is your key points of what one should consider when investing in cryptocurrencies? Over to you.
Thanks. I would just like to start by saying that I think Amit did such a terrific job. And in fact, Amit, everything you said applies to crypto equally. From like do your own research, even if it's a great token, a great, the massive price correction can happen, doesn't mean it's a scam. And, all of those things. I mean, literally word for word, I can have the same thing applied to crypto as well. And that's just the point that, I want to begin this with. That so the first thing, Raghu, that one has to consider between whether they should or they should not look at crypto seriously is first, do a little bit of like walk down history, take down a history walk. Now, what is the most headline consuming narrative today when you hear the word, Bitcoin or crypto? What we hear is that crypto is for misfits, it's for drug dealers, it's for degenerates, it's for pornographers, terrorists, thieves and swindlers. Only those kind of people. Let's hope that none of us in the room are one of those over here, because the headlines will have us believe that anyone who's into crypto, what else motive could they have if they are not, a thief, a terrorist, a swindler and whatnot, right? So, and why did I say go down history? So, so I came across this, where it was written in one of the books that the first cars were used only as getaway vehicles. The first telephones were used to plot conspiracy. The first telegrams were used to run long-distance mail fraud schemes and Ponzi schemes. And the first forms of electricity were used to run medical hoaxes and scam people. So And if we go down and we look at what the Time magazine or any of the popular publications at that time said about people using electricity for the first time, they were like, why do you need electricity? We have gas which can heat our homes. So why do you need electricity? It's like putting lightning in your walls. Your wires will burn down your house. Why do you need an automobile when a horse carriage can do it equally well enough? And it was written that the automobile is the most dangerous technological innovation of its time and will endanger the human species, because it was an autonomous vehicle that didn't have men in front of it, navigating it. So it's really important to put this technology and any new technology into perspective, that there is always, and technology is purpose agnostic. Now, what is the second thing to consider about when you are looking at cryptocurrency as a technology and whether you want to invest in it or not? That what is the crux of the technology? What is it bringing to the world that is so different? Like when we went from horses to automobiles, we went from gas lighting to electricity, we went from printing press to the internet, right? We went from so many, so what is that game changer? What is it that cryptocurrency is bringing to the world? Amit, to your point on economic theory about why the tech companies in the last decade have been doing phenomenally well, because there is no limit. You can keep creating as much as cloud computing space as possible, right? So the Web 1 and Web 2 technologies have sort of built their fortunes on a principle called digital abundance. And we have seen all this massive growth because of digital abundance. What cryptos or Web3, a more umbrella term, is capturing, and the principle, the investment thesis around it is that it is now bringing back digital scarcity. When I say bringing back, it means it's bringing scarcity of resources to the digital realm, which we've never had. In the digital realm, we've lived in a world of digital abundance. And the major pivot or the major disruptor with Web3 is that it is bringing digital scarcity. It is bringing scarcity to the digital realm for the first time. And when you have scarcity, only then can you ascribe value to something. And only when you have value do you have property rights and ownership rights attached to digital media, to digital files. This has never been possible before. Sure, you've had copyright laws, or you've had other sorts of intellectual property laws, trying to prevent and show who is the owner of what digital property online, and then disallow its illicit use. But this is the first time that the technology by design is giving you property rights in the digital realm. And so what Bitcoin or crypto essentially is, that it is a digital bearer asset. Cash is a physical bearer asset. When we moved on to the digital world and the fintechs and digital banking and all the disruption that happened in this space, we used the same paper currency, but gave it a digital interface. But it was used in much the same, but we needed intermediaries, and we needed third-party intermediaries to reconcile books across centralized ledgers to make payments and settlements. Now we have a disintermediated, decentralized payment and settlement network, so you can exchange value over the internet without intermediaries because of this innovation of digital scarcity. So it's really important to understand that this technology is about digital scarcity, disintermediation, and decentralization. And these three things have numerous use cases. Each use case is represented by a token. So Raghu, when we were talking earlier, we were saying that, there are thousands and thousands of tokens and cryptos. How does one choose? You can sit in 5 days or 1 day and spin up a token. Absolutely. We are living in the age of permissionless innovation, where any idea that you have, you can spin it into a project and overlay it over a Web3 protocol as opposed to a Web2 protocol. And each of these applications on these Web3 protocols are supported and are run and are anchored on their own tokens or on their own cryptos. So, which is why an investment strategy, and which is what Amit said, that you have to do your own research. Anytime you pick an specialist, an investment specialist, depending on how much money you're coming into this space. But there's no shortcut to research. There is no shortcut. I've learned a new word today called vintage risk management. But what we in the crypto space, how we have been looking at this is that we do dollar cost averaging or dollar value averaging. If you have $100, you ain't going to go in with $100 no matter how bullish the market sentiment is. And if you have $100, neither are you going to go into all of it at once, and neither are you going to put all your eggs in one basket. So you look at DeFi, you look at NFTs, you look at in-gaming assets, you look at collectibles market, you look at lending and borrowing protocols, you look at the problem that these projects are trying to solve, but using a new technology paradigm. It's like automobiles were solving the same problem that horses were, getting people from point A to point B, but the automobile was just more efficient at doing it. So similarly, for your crypto asset investments, you look at how it's trying to solve a problem in a better way or not. How decentralized is it? What is the protocol it's running over? Now, another very important thing for potential investors to keep in mind is that when you say that my project is built on the blockchain, that means nothing. There are multiple blockchains. And each blockchain, which is called the infrastructure or the protocol layer, a Web3 protocol in its own right, has got many projects or applications built on top of it. So as an investor for the first time, and this is really crucial to understand, you have the opportunity to invest at the infrastructure level and at the application level. Let me just contrast this with Facebook, Amazon, Google, and YouTube, and all the digital networks that we have been investing in so far. These are all applications that were built. All these companies I've named are nothing but applications that were built on the infrastructure level layer. What was the infrastructure level layer of Web 2 protocols? TCP/IP, HTML, HTTP. So imagine as an investor now, you can invest in TCP/IP. TCP/IP is Transmission Control Protocol or the Internet Protocol. So imagine investing in internet.inc, in the Internet Protocol. You're buying a token that gets more valuable as much as the internet grows in demand. I'm not even talking about the companies built on top of the internet. I'm just saying as much as the internet grows in demand, I have invested in protocols that make the internet run, the protocol level layer or the infrastructure level layer to run. And then as an investor now, I also have the option to run on projects and applications that are running on these different protocols. So, and this is called the FAT Protocol Thesis. For whoever amongst us wants to go read this, it was written by someone called Joel Monegro. The FAT Protocol Thesis, that in crypto investing and in the Web3 and in the crypto space, a lot of the value is getting captured at the infrastructure level. Bitcoin is a protocol level layer token. Ethereum is a protocol token. Solana is a protocol token. Projects, all NFTs are applications, are app level protocol projects which are built on. So these are called application tokens or utility tokens or some DeFi tokens like Aave, Compound. These are all banking applications running on Web3 infrastructure providers. So, I mean, the reason I'm explaining all this is because I'm going to drive home the point of how important it is what Amit literally said, that you have to do your research. And market corrections doesn't mean that a project is a scam, because in the Bitcoin world, every time, of course, and Bitcoin has a lot more volatility because it's very thinly traded. right? So few moves in the market can really drive the volatility up and down. But that doesn't mean that it's not fundamentally, like on a fundamental level, there's something wrong with it. It's just massive market corrections are happening. In the Bitcoin space and in the crypto space, market corrections are almost synonymously used for it being a scam or a bubble. See, Bitcoin is dead. Bitcoin is dumping. Governments will shut it down. This will happen. That will happen. So it's important to have a clear focus and to not get so misled by misinformation in this space. Also, thank you, Amit, for bringing up the market cap of these five largest technology companies, right? Of course, none of them are from India, but all of them are essentially, what are they? They are digital networks. In the last 12 years, 10, 12, 15 years, the largest companies, the largest by market cap, they have essentially, and so we can safely say that the best ideas in the last 10, 15 years have been on projects written on digital networks or projects built around a digital network. Your Facebook, Amazon, these are all digital networks. So what is Bitcoin? Bitcoin is, in the monetary history of the world of 5,000 years, Bitcoin is the first monetary digital network. It's like Facebook for money or YouTube for money. That's all that it is. And the Bitcoin reached $1 trillion market cap in how much time? How much time did it take for Bitcoin, for a digital monetary network, for the world's first monetary digital network to reach $1 trillion market cap? And how long did it take for Google and Amazon to reach $1 trillion market cap? It took Google 22 years and it took Amazon 24 years to hit 1 trillion. It took Microsoft and Apple around 40 years. And we have Bitcoin. So where is the market and where is the money going? What is the markets telling us? That yes, digital networks, thumbs up. Monetary digital network, a double thumbs up, right? So I mean, and of course, we can get into many more details. I'm happy to take questions, but so
I think I was just going to say on that note, I think this topic is so emotive. It brings out so many strong emotions in Shikha. So I'm sure you can go on for a couple of more hours on this.
Yeah.
But due to paucity of time, I'm going to request you to pause right now. We will take questions at the end. And I'm going to very quickly shift gears, if you permit, Shikha.
No, I have to say one more thing.
Please go ahead.
It's on the crypto crimes. It's on the illicit activity part, which I haven't given any numbers on. So according to the United Nations, the UN estimate is that 2 to 5% of global GDP is annually connected with money laundering. So illicit financial activity as a percentage of global GDP annually is around $1.6 to $4 trillion annually. This is a UN estimate. All good. And this is a 2 to 5%. Now let's look at in the world of cryptocurrency transactions. In 2021, only 0.15% of all cryptocurrency transactions were connected to illicit activities or money laundering, 0.15%. In 2020, it was 0.62%. 2019, it was higher, 3.37%. So if you go from 2017 to 2021, for when we actually have data and when cryptocurrency hit mainstream adoption and we saw the price in 2017 go to $20,000, the percentage of illicit activity of all cryptocurrency transactions is at 0.15%. But the growth of cryptocurrency transactions from the last year to this year is up 567%. So the rate of growth of...
request you to pause right there. I think we've got the point that crypto is a great thing, and a triple thumbs up to Shikha for that. And we're going to move on very quickly on global investments. And Alex, who's based out of Mauritius and has a huge amount of experience in not only the Indian markets, but also the African markets. So, Alex, I'm going to request you to share your thoughts on, your experience in basically investing in the public markets with respect to Africa in particular. Governance obviously is an area where a lot of people have some concerns when it comes to Africa, African companies. What are your thoughts on a couple of these issues? And then we'll move on to ESG next. Over to you, Alex.
Thanks a lot, guys. Really interesting to listen to both Amit and Shikha. Just to draw a parallel to Africa, I think Africa, investing in Africa is as traditional as what Amit described as vintage risk, and it's as volatile as can be when it comes to crypto. The reason being that many investors basically see Africa as the last frontier. As other markets mature, everyone sees Africa as the last frontier. Again, it's probably because of the fact that it's 1.4 billion in population, and it's really blessed with many natural resources. I think when it comes to investing in Africa, I think you probably have to look at it as an alternative investment. Because even now it's still very difficult to invest in Africa. I mean, how are you supposed to invest in it? I mean, the equity markets in Africa in particular are very illiquid. But if you look at investing in bonds, in treasury bonds, country bonds, they still actually give a lot better returns than you get in America. Again, I speak under the correction of Amit, but I think if you look at fixed income in America, I think the returns are probably Amit, again, 2.5% to 3%, if I'm not mistaken.
Yeah. At best.
At best 2.5% to 3%. But if you actually look at like some of the bonds that you can get in Africa, they can range anywhere between 8% to 14%. So this is the same kind of asset class. Now, I think the important thing to understand about Africa in particular is that it's different. Let me break it down into three brackets, right? So there's Northern Africa, which is flooded with oil assets and major industries. So of course, oil is a great commodity. You see Southern Africa, which is strong in mining. There's gold, there's platinum, there's chromium. Again, a great asset class to invest in. And then, of course, there's Sub-Saharan Africa. Now, how do you invest in this? I think the way to look at it is there's of course the traditional investor. And interestingly, I just pulled up this fact the other day that actually Africa offers the highest return on FDI in the world. And this was according to the Overseas Private Investment Corporation and UNCTAD. So really interesting. But now, how does one invest in Africa? I think there are two ways to do it. So either, you can look at alternate investments like PEs and VCs, where you can, through a family office or as an individual, maybe if you are a high net worth individual, you can commit a certain amount of capital to Africa. But there's also another way, which again, I'm sure Amit will be able to help with. But they're ETFs, right? They're exchange traded funds and mutual funds. And, again, in the essence of everything that, Amit and Shikha was saying about, about building in the diversification, I think this is how ETFs and mutual funds can help. Again, I think the best way to understand it is if you're looking at this as an individual, as Amit said, diversify your portfolios. ETFs and mutual funds are a great way to invest. You can also look at, coming into certain, bonds, government bonds, country bonds, which are traded as well. And again, if you have a lot of capital, best way to do it is you can again de-risk yourself by going into different industries, but you can do it through a private equity or a VC fund. Yeah. So this is really in a nutshell, how I can break it down for you guys. Again,
thanks so much, Alex. What is your thought on ESG?
You can again de-risk yourself by going into different
recent
industries,
LIBOR, which has been replaced how does
so this
that,
is really in a nutshell,
how does that kind of impact,
break it down for you?
The bond markets, and there has been a lot of volatility we were talking about earlier in terms of the macro threats for 2022. Fed announcements for interest rate increase, inflation. Other than COVID, which is obviously got a huge impact, you've got war risk hovering with Ukraine. What, as per you, is the macro threats going forward in 2022? And specifically from an Africa point of view, do you think that the ESG investing story has finally come around to being a big action point?
Well, Raghu, I think with regards to ESG, I still believe that we're still in the nascent stage. Yeah, I mean, people like global leaders still can't accept the fact that there's climate change going on. So what are we talking about ESG with corporations? Yeah. So I still believe that I think with regards to ESG, I think it's still fairly new. Yes, let's also consider looking at alternatives. I think this will be the future, but I don't see this happening in the short term. I don't see this happening in the short term or the medium term. I think this is still a story which is slightly further away. I think some of the, and again, I think Amit would be a better person to speak on this, but I think some of the big fundamentals that we have to, really consider right now are, again, the inflation and devaluation, which are two big topics. But again, I think just from a global perspective and in building a portfolio perspective, I think probably Amit might have something more to say on that. Yeah. Amit?
Yeah, I mean, I'll do this quickly because I know there are other people who have to speak. But see, the last 2 years, what we've seen is a massive liquidity infusion by the central banks, right? I mean, if you look at the US Fed, they have been printing $80 billion a month. If you look at the ECB, they've been doing $30 billion a month under 30 billion euros a month under their EPP, and then they have a TARP program which is 20 billion euros a month. Now, what the Fed has just announced is that they're going to, and they've already cut it from 80 billion a month to 50 billion a month. And what they're now saying is by 31st March, we are going to basically end all QE, which means the asset purchase program goes away. So suddenly the world is now facing a situation wherein which there was a lot of money being printed, which is going away. Europe also has said that they will stop the EPP. They will continue their TARP, but they're reducing it to 10 billion, which they're going to use it to support for 6 months. But basically what's happening is all the free money which was being printed in the world is going away. And the reason they're doing that is because the December inflation numbers were very scary. And there's industrial inflation, there's structural inflation, but there's also something called service sector inflation. Now the structural inflation will go away once the ports get operational, and that will also address industrial inflation. But when you have service sector inflation, wage level inflation, that doesn't go away. That is a very sticky inflation. So what's happening is we've got a global macro where suddenly a lot of money going away. And there is inflation. So the central banks are worried as to what to do. Now, there is a talk about Fed raising rates. There can be 3 hikes, there can be 5 hikes. If you watch CNBC, your brain will get fried within 1 hour and you won't know what's happening. But the reality is that even if the US increases its rates by 75 basis points, the US incremental expenditure to service their debt is more than the US entire annual defense budget. So that's a staggering number we're talking about, right? So basically, you've got, unfortunately, we're in a very fragile global macro where liquidity is being withdrawn sharply. The Fed has said they will increase rates. Nobody knows whether it's going to be 3 or 5. And there's this unwinding of liquidity which has happened in the last 2 years, which is now going to happen over the next 6 months. And between now and 31st March will be the end of QE. And then after that will be the rate hikes. Now, people were expecting a rate hike yesterday. which the Fed didn't do. I think they're seeing already the impact of the QE unwinding. So, Raghu, the reality is unfortunately that the global macro is fairly shaky just now, right? And what we've experienced in the first 25 days of January, I suspect if, investors need to be very careful at least till 31st March.
Right.
Because this unwinding of liquidity, unfortunately, is going to hit every asset class, right?
Yeah.
Equities will go down, debt will go down, because when rates go up, debt funds go down, right? When rates go up, real estate goes down because leverage becomes more expensive. So this unwinding is going to affect every asset class. So we just need to be a little bit careful this quarter.
Tough times ahead. Thanks so much for that, Amit, and thanks, Alex, for your comments. We're going to quickly shift gear to Varun, who is our next speaker, who's going to talk about investments in REIT funds, P2P lending, and the pros and cons and alternative investments. So Varun, my question to you is, the last decade has witnessed emergence of investment opportunities through REITs and P2P lending. How can an investor decide between these options? Over to you, Varun.
Thank you, Raghuji. So at first, I welcome all my brothers and sisters attending this webinar today. So friends, in time of technological advancement, or I would say the age of fintechs, today investors have plethora of investment revenues available at their fingertips, which were not available a decade ago. Some of the most popular options are the REITs and the P2P lending. So I will start with REIT. So REIT is a company that owns and operates or finance income-generating real estate. These are modeled after the mutual funds. REIT basically pool the capital of numerous investors. This makes it possible for individual retail investors to earn dividend and capital appreciation from real estate investment without actually having to buy manage or finance these property directly. Since their launch in April 19, REITs have paved the way for the retail investor to participate in the commercial real estate class. REIT offers, the post-tax returns, which are almost twice as much as you can expect in the fixed deposits or the recurring deposits or the government bonds or the other club. Very interestingly, over the time, they have emerged as one of the most viable investment alternatives. You would have seen recently I would say the Paytm stock that is trading, almost 50% of their issue price. And it just recently listed a month back only. Whereas in spite of the COVID outbreak a couple of times, neither the Embassy Office Park REIT nor the Mindspace Business Park REIT has ever traded below their issue price. This is one of the very interesting facts. And REITs in India collectively have a leasable operating area of 77 million square feet, which is almost all category A, rental generating commercial real estate. And REITs in FY21, as per the SEBI record, have raised 14,300 crores. Their NAV stood at whopping 58,000 crore plus at the end of FY21. Recently, SEBI has also reduced the minimum application value of the REIT to INR 10,000, which was earlier used to be 50,000. And also the minimum trading lot has been reduced to 1, which was earlier 200 unit. So now this also makes it more accessible to even very, very small investors. With the GDP forecast indicating 8 to 9% growth, in fact, just a day back, IMF has the view that the Indian economy will grow in FY22 as well as 23 by 9%. The commercial real estate sector is expected to bounce back strongly. REITs are then likely to have an accelerated entry into the market. This will lead to a win-win situation for all. The occupier will get a better quality and managed building, and investor will also get a choice of REIT across the asset class. Coming to the P2P lending, it is relatively a new phenomenon in India and has witnessed in the last 5-6 years. India has witnessed multiple P2P lending platforms like the Money Club or like the Landbox. These platforms offer loans for businesses, personal use, or anything else you can imagine. If you join the pool of investors who are willing to loan money to others, then the loan can be funded by you once the borrower qualifies. There is no bank involved in the P2P thing. So in P2P, your money is typically pooled with the other investor money, and together you make a loan to the individual seeking the funds. The main risk with the P2P lending is that you are lending to those people who are not able to get the loan from the bank or the other loan outlets, which could increase their likelihood of the default. However, you can decide the credit rating and other parameters you will consider for a borrower in which you would like to participate. Within a short time, combined loan book of P2P platform in India has crossed 5,000 crores mark. An investor through this platform can expect return anywhere in the range of 10 to 20%. The Indian P2P lending market size is forecasted to reach $10.5 billion by 26, and between 21 to 26, it will witness a CAGR of 21.6%. The P2P lending market growth is attributed to increasing transparency in the P2P lending with technologies such as the blockchain and smart contracts being incorporated into the lending platform. The Indian government enthusiastic promotion of cashless technologies has also managed to restructure the financial sector, disrupting the long-held monopoly of the traditional institution like the bank. Platform-based lending will invariably gain huge momentum over the forecast. Thank you.
Thank you so much, Varun. I think that was a very insightful thought about REITs. I think most people are seeing around them some revival on the real estate front. So I think REITs is a good, relatively lower risk, platform as compared to direct real estate acquisitions. With that, I'm going to switch gears very quickly due to paucity of time to our last speaker for the day, Prakash, who is going to talk about some of our tax issues in the alternative investment space. Over to you, Prakash. What are your thoughts on some of the issues that we were talking about? Maybe you would like to talk about crypto. I think that is something which a lot of people, even in the budget, expect a new framework, to be announced. That we've seen is a very emotive topic. Crypto seems to be, especially with the younger generation, catching their fancy. So over to you, Prakash. I think you're muted. You'll have to unmute yourself.
Thank you, Raghu sir. So due to paucity of time, I'll just shift my gaze to cryptocurrency. So what are the budget expectations we can expect in the cryptocurrency? So still there is a no clarity, like whether this crypto is a currency, whether this crypto is an asset. That clarity is not, since there is no legal backing from the government for this cryptocurrency. Earlier it was banned by the government. Then the Ministry of Finance came recently saying that we are going to legalize it. So we are expecting more things in the budget with regard to this cryptocurrency. So what are the things we can expect from this? One is how these provisions will be inoculated in the Income Tax Act, providing the taxation for the cryptocurrencies. Then whether the payment, like when we are making the transactions, whether the payment for transactions can be done through cryptocurrencies. So that is one of the questions now. So the Income Tax Act might provide in the coming budget more clarity whether the transactions done through cryptocurrencies are legal. Then if a person pays for a good or services through cryptocurrencies, whether that is also a legal transaction. So then cryptocurrencies are mostly brought in foreign currencies. So what is the exchange gain fluctuation? How it will be treated? So that also is one of the big questions. Then if a person wants to offer the income on a presumptive basis, it is necessary that the transactions in cryptocurrencies will also be covered. We have the presumptive taxation, so the cryptocurrencies will also be covered. So in this budget, we can also see whether the government can consider levying TDS or TCS on the sale and purchase of cryptocurrencies above a threshold limit. So this is one of the things. And how the cryptocurrencies will be taxed, whether it will be, if you are regularly dealing, whether it will be a business income, or if it is an asset, whether it will be a capital gain. That also is one of the big questions. And how the taxation rate will be for the cryptocurrencies. The taxation rate might be, we have to tax it at higher rate, whether it will be treated as an income from gambling or something like that, or arising from lottery or games, or what kind of transaction cryptocurrency is, because there is no clarity as such as of now. So these are some of the things we can expect in the cryptocurrencies. And one more thing, last thing, just I'm going to touch, I'm not going to take much time. So like if the companies or if the people are given cryptocurrencies, so how the cryptocurrencies will be taxed in their hands, whether it will be taxed as an ESOP or whether it will be treated as regular salary, because all the people now are issuing the tokens and NFTs to the employees to instead of these ESOPs. So whether it will take the place of ESOP or it will take place of the normal salary, and how the valuation will be done, how the taxes will be levied, whether it will be levied at the maximum rate or whether it will be levied at the lower rate. All those things are like controversies, and we can expect more clarity in this budget. So with this note, I'm just going to end my speech due to paucity of time, because I had other issues also, but I don't want to cover because just paucity of time. Thank you, Raghu sir.
Thank you, Prakash. Thank you for pivoting very quickly. I know you had spent a lot of time in preparing a very elaborate tax, issues, but I think we're going to shift to question answers. There is one question which I think was aimed to Shikha, which she's already answered on NFTs, in terms of which is the best site for investing in NFTs. Are there any other questions from the panelists that may have? Alex, Amit, any questions on crypto or REITs or taxation? Anybody has any thoughts on anything like that?
I just do a quick one, Raghu. I thought everybody will find this interesting, especially Shikha, now that she's the focus of everybody's attention in this conversation. The Economist's word of the year for last year was DeFi, which is decentralized finance. So I don't know if you're aware of that, but I guess that's where the world is moving to.
Absolutely, absolutely. Thank you for that. And I want to thank everybody by ending with the words of John Templeton, who had said famously that the 4 most expensive words in the English language are "this time it's different." So with that, I hope and pray that you all are very wise on your investment and don't make the same mistakes again. And thank you all for participating, and thank you all the panelists for being so patient with us. Thank you so much, and we're going to sign off. Bye-bye. Thank you.
Thanks.
Thank you, everyone.
Bye, everyone.
Bye-bye. Bye-bye.